Hello, everybody. Thank you for joining us this morning. My name is Chris Wilson, and I'm head of the business development team here at Myerson Solicitors. Today, we're going to be talking about a hot topic of employee ownership as a succession planning model for businesses. We're going to look at employee ownership trusts, delve into their tax advantages, how they're structured, and the benefits to the business and its employees. And if you're considering your succession planning options, then employee ownership is certainly one for the list for you. So we're joined by our expert panel today, and I'd like to introduce you to Simon Nolan from our corporate team. Simon has a wealth of knowledge advising businesses on succession planning, including employee ownership trusts from the legal perspective. We also have Jordana Reynolds, the People and Culture Director here at Myerson. Jordana played a key role in supporting the firm and our people throughout Myerson's transition to employee ownership. She led on the internal communications to drive employee awareness. She ensured transparency around the process and also helped to foster engagement at every stage. Her work has been really instrumental to maintaining and enhancing the firm's culture and helping us to thrive under our new EOT model. I'm also pleased to be joined today by James Fraser, the tax partner at Armstrong Watson Accountants. Armstrong Watson are also at the forefront of advising employee-owned businesses, and specifically on the tax, accounting, and the corporate finance elements of the conversion. So we're pleased to have James with us today as well. Now, as some of you will have seen in the press, we are proud to be and have become Manchester's first 100% employee-owned law firm. And as James and the rest of the guys will come on to later, becoming employee-owned business isn't all about the tax savings. When it comes to Myerson, we have really had a sort of a people-first culture, and our ethos has always been to remain independent and to only grow organically. So the tax advantages aside, becoming 100% employee-owned really has sort of reaffirmed our commitment to this, and it really does align with our core values. It also allows us to give every single employee a stake in the firm's financial success. It really does empower our people. It helps attract new top talent, and it reinforces that real people-centric culture. And the best part for us is that we're able to do all of this together. Now, today, we probably won't have time to deal with any questions that you may have live on the webinar this morning. So if you do have any questions, you're more than welcome to put them into the chat, and we can provide the answers as a Q&A in the follow-up email. You can also contact all of our speakers today too. Obviously, their contact details are on the screen, and they'll be on the screen again at the end of the webinar as well. We'll also share all their contact details with you again in the follow-up emails in due course. So obviously, firstly, succession planning is clearly high on the agenda at the moment for businesses and for business owners. And the EOT model is now starting to take a more central stage position and be really part of people's succession planning. So Simon, I'll come to you first, if I may. Can you just explain a little bit more, please, about the EOT model and why becoming employee-owned is an attractive prospect for businesses?
Yeah, sure. Thanks, Chris. So as you mentioned, the EOT model is really a form of succession planning. Employee ownership trusts, as they're formally called, were established in 2014 to promote employee ownership as a business model in the UK. And some of the better known EOTs include the likes of John Lewis and Richard Sounds. The model is an attractive succession model, as they can provide a stable long-term ownership solution that benefits not just the sellers, but the business as a whole and its employees. It also carries with it numerous tax advantages, which we'll come on to shortly. Crucially, by transferring ownership to an EOT, the business owners can ensure the company remains independent and aligned with its existing culture, whilst the employees gain a vested interest in the company's success. And studies have shown this actually often leads to increased productivity and retention of staff.
Brilliant. And obviously, Simon, I know that you deal with a lot of the sort of legal technical points when it comes to these EOT conversions. Maybe could you explain a little bit about how the employees actually acquire the ownership interest and what kind of structures are used to do this?
Yeah, sure. So an EOT uses a trust-based structure. In a nutshell, a trust is established by the company as set law for the purpose of acquiring and owning the shares in the trading company for the benefit of the employees of the company who are the beneficiaries of the trust, thereby creating indirect ownership of the company by its employees. An EOT usually has at least 3 individual trustees or a single corporate trustee, which is normally a company limited by guarantee, with the 3 individuals who would be trustees acting as directors of the corporate trustee. This model is usually adopted in practice as it avoids the administrative burden of dealing with the retirement and appointment of individual trustees. In addition, because the role of acting as a trustee brings with it significant responsibilities, trustees can also be sheltered from personal liability if they perform their role by acting as a director of a corporate trustee, which provides limited liability. Although individuals should also note acting as directors via corporate trustee brings with it duties and responsibilities arising from their role as directors of a company. Since the 2024 autumn budget, there's also a criteria now that the trustees of the EOT that the sellers do not have a control over the trust or account for more than 50% of the trustees as a whole. And this is usually addressed by the appointment of an individual who is independent, either a professional or someone who is outside from the business itself. And additionally, another trustee is appointed who's usually a serving employee of the company and is not on the company's board of directors. It's also often the case that the seller also sits on the board of the trustees.
Yeah, and I think that's exactly what obviously we did at Myerson as well. We appointed our corporate trustee just to sort of maintain continuity if one of the directors wants to step down or retire. So we appointed 3 directors, a representative from the original business owners, an independent trustee, and then also an employee representative as well. Obviously, at the beginning, I mentioned EOTs are taking more of this central stage when it comes to succession planning. What sort of trends, Simon, are you seeing with the businesses that you're sort of speaking to when it comes to EOTs?
Yeah, in recent years, we've seen employee ownership become increasingly prevalent, with EOTs gaining traction as an ownership structure due to the significant benefits it offers both to the present owners and the business and its employees. This trend is likely to continue as the number of EOTs continues to grow in the UK. Currently, there's around 1,800 employee-owned businesses, reflecting a strong movement towards this inclusive and sustainable business practice. The EOT model was designed to promote employee ownership, as I've mentioned, by providing tax-efficient ways for business owners to transfer ownership to their employees. And as James will mention shortly, the Finance Act 2014 offers the selling shareholders 100% relief from capital gains tax on the disposal of their shares, provides strict requirements are adhered to. And recent changes to the rate of capital gains tax and business asset disposal relief, also known as BADR, as announced in the last budget last year, are likely to make EOT ownership an even more attractive succession model for current business owners, provided that their business is suitable for employee ownership as a whole.
Super, thanks. And I'll probably come on to you, James, actually. You help many business owners with their succession planning. And obviously a key element of that is really understanding the various tax positions. And I'm just wondering what are the tax advantages of becoming employee owned really for both the business owners and the employees?
Okay, thanks, Chris. I suppose taking the first one that Simon has just touched on, the tax advantages for the business owners selling into the trust. I'm going to put a slightly different spin on it. Rather than a tax relief, I'm going to call it a tax deferral. So when business owners sell their shares into an EOT and the EOT qualifies for all the reliefs, and I'm sure we'll come on to that in a bit, the business owners don't suffer any tax. Effectively, the tax that they would suffer is deferred into the trust. So it stays there, but effectively it isn't the business owner's problem, potentially. So that's obviously a key advantage, and particularly advantageous where the business owner wouldn't qualify for business asset disposal relief. So there is a requirement for the company to be a trading company, but there might be individuals who have shareholdings in trading companies where they don't qualify for business asset disposal relief. For example, they don't hold a 5% shareholding, or they haven't held the shares for 2 years. Sale into an EOT effectively doesn't matter for them. They get to defer their CGT into the future. EOTs tend to be funded out of company profits or post-tax profits. So it's cash that's flowing from the company into the EOT to fund the purchase from the exiting shareholders. So there doesn't tend to be a need to fund the income out of income tax rates cash, where you might have an MBO or some other third-party purchaser coming in. And the other benefit for employees is that employees can receive a tax-free bonus of £3,600 a year, or up to £3,600 a year. There are restrictions around that bonus, in that the bonus has to be applied equally to all employees, albeit you can tier it according to maybe employee service or seniority such, but all employees of a certain grade would have to share equally within that bonus pot. The one thing, the common thing that gets missed around that is that it's a tax-free bonus, not an NI-free bonus. So there is still employees and employers NI on that bonus.
That's great, James. And I also obviously understand there are some actual conditions as well that need to be satisfied to sort of obtain those tax reliefs under EOTs. And I just wonder if you could touch upon what those conditions are really.
Okay. So the first one is it must be a company that we're looking at. So if you're not a corporate structure at the moment, it might be that business has to go through some form of transition to get it into a corporate structure before it can then pass into EOT ownership. The second one we need to look at is something called the trading requirement. So again, I mentioned that slightly earlier, that the company has to be a trading company. So if there are investment activities going on within the company, so investment properties, large cash reserves, etc., that would be something that would need to be looked at for conversion into EOT ownership in order to get the tax reliefs. The government or HMRC introduced a number of new measures from October 24 just to try and, I think, crack down on some artificial EOT structures. And one of them related to residency requirements. So from October 24, the trustees of the EOT all have to be UK resident. There was a phase where you went through having a number of the trustees based offshore, and that effectively goes back to a technical tax point around the capital gains tax position around the trust. If that were ever to come back into play, if the trust was resident overseas in the country that didn't have a CGT rate, arguably that tax never bites. HMRC have closed that loophole, so the trustees all have to be UK tax resident. As I mentioned before, bonuses have to be shared out equally between all employees. The EOT has to benefit all employees as well. You can tier it again according to seniority, salary rates, length of service, or however you want to do it, but there's got to be a fair share of the EOT's assets for all employees. The key one is EOTs have to hold more than 50% of the company's share capital. And that can be one where companies come a cropper. They do something post conversion to drop the shareholding below 50%. Again, another of the new rules that came in is a bit of an awkward one to actually justify and gain certainty before conversion into EOT ownership, but it's something called the consideration requirement. And this is a requirement that says the trustees have to make sure that they are paying fair market value to acquire the shares in the company, so they're not overpaying the exiting business owners. And in that respect, they recommend that a professional valuation is undertaken of the company's shares to make sure the trustees are paying fair value for them. A couple of techie tax points, which I won't spend too much on. The independence requirement, That's Simon touched on that briefly. It was another change from October 24, and it meant that the majority of the trustees have to be effectively unconnected from the company. Third party, either professional trustees or an employee council, not related to the former business owners. And there's also something called the limited participation requirement. This is targeted towards very, very, very small companies with very low numbers of employees. And what it's designed to counter is a company with a couple of employees who are also the shareholders, one of them selling their shares into a trust and then continuing to operate the company. The actual rule says that the number of individuals who continue to hold direct shareholdings in the company post conversion into an EOT can't make up more than 40% of the overall employees of the company. So if you've got a company with a large number of employees, small number of shareholders, it should never be a problem. It's for those small companies with 2 or 3 employees, maybe a few more, who want to convert to employee ownership, where that might be an issue.
Well, that's great. Thanks. We've definitely had some inquiries from businesses that haven't met those criteria. So it has been interesting that, you know, when we come across them, we have to make sure that those criteria are met. And James, are there any sort of myths or any misconceptions or pitfalls, do you think, of selling to an EOT and becoming employee owned?
I'll start with the pitfalls in the first instance. So all the rules we've just gone through, they apply both at the time you go into employee ownership, but they also apply after the EOT is in place. And they become then what's called disqualifying events. And if you fail to meet one of those conditions within a period of time after conversion to EOT, potentially that capital gains tax deferral can be clawed back. And the window for that now is not just the tax year in which you make the disposal into the EOT, but also the 4 subsequent tax years. So you've got to monitor what happens in the EOT for quite a long period of time if the business owner doesn't want that tax charge to come back and bite them. Even after that period of time, if one of those events, disqualifying events, takes place, it can be the trust that's lumbered with quite a large tax liability. And the one that we see quite a lot is where you fail to meet that 50% shareholding, which you get quite a lot if you just set up with EOT holding, let's say, 51% in order to get into the EOT rules. And then you want to put in place an employee share scheme. And then that share scheme exercises those shares and it's a new allotment of shares. And suddenly the EOT shareholding goes from 51% down to 49% or something less than 50%. At that point, you've triggered a disqualifying event and the EOT suddenly has a tax liability because it's deemed to then dispose of and reacquire those shares that it holds in the company at market value. And whatever gain there is on that, it's going to suffer a capital gains tax charge. So we see that quite a bit. We see a lot of business owners who want to sell part of their shareholding into an EOT and retain a balance. So again, I'll come back to that. Sell 51% into the EOT in order to qualify for all the tax advantages and retain the balance of shareholding. I struggle with that from a conceptual point as to what they're going to do with that 49%, other than a sentimental reason for holding onto those shares. Partly because going back to one of the conditions that the EOT has to meet when acquiring shares, it's got to pay fair market value for those shares. And from an EOT's perspective, if it already has a controlling interest in the company, it's not incentivized then to pay full market value for those shares. It would probably apply a minority discount for any additional shares that it's going to acquire. So I think the business owners sometimes fall into a trap of thinking they'll get full value for those shares on the second sale, where actually they probably won't. They'll get a discounted amount. And that applies equally to any shares that might be allotted to employees as well. The EOT effectively becomes the long-term owner of the company, or that's how it should be seen. And that's going to be the market for employees to sell their shares as they come and go from employment. So again, it's what value is the EOT going to pay for those shares? It's not going to be like if you sell to private equities, you sell to a trade buyer where you're going to get full value for your shares, maybe a small premium, you're probably going to get a discounted amount. The other points I would raise is around, you touched on it right at the start, EOTs are all about culture. This should never be done for the tax benefits. The tax benefits are just an added bonus. The EOT should be entered into because it suits the culture of the business, it suits the long-term ownership. Again, I've had a number of clients that have come to me after converting into EOT ownership saying, we want to exit now. We want to sell out to third party. And as bad as it sounds, you have to sit down and tell them that by the time all the tax charges have been totted up from selling the EOT, selling the shares, there's not going to be a massive amount left over at the end. The EOT is a fantastic ownership structure for continuity, long-term ownership, preserving that business. But in terms of if people want to flip it and sell to third party at some point in the future, it's maybe not the best structure for them.
Yeah, that's great, James. And it's exactly why, we became an employee-owned business. And as you say, it's not all about the tax savings. It was about providing our employees with that continuity, that stability, enabling us to provide, a positive growth strategy for the business. And it's something we could do together. And Jordana, sort of coming on to this topic with you now, really, what would you say is the key sort of cultural and communication factors that businesses need to consider when they're preparing for employee ownership?
Yeah, thanks, Chris. And I think James has sort of set me up really well to start with this one. But I've spoken with a number of different companies since we became employee owned. And one of the consistent messages that I hear is that companies who've had the most successful transition to employee ownership tend to be the ones that already had a really healthy culture. So becoming employee owned can really amplify your existing culture, which does mean the good elements, but also the bad. So when considering the journey to employee ownership, it's worth starting by considering the culture that you already have in your own company and what values and behaviours you feel are needed in order to sustain a successful employee-owned company for the future. So, for example, thinking about things like are there already a sense of trust in the organisation, kind of sense of collaboration, shared purpose within the company. Do employees understand the objectives of the business and its long-term strategy? And if there isn't already that strong foundation in place, that is definitely something that should be considered as part of the strategy in advance of transition. And the other thing to remember is that change of ownership is still a change, even though it might be a positive one. So there is a risk that some employees might feel quite unsettled or even a little suspicious of what's happening. And all employers should be making sure that they are kind of considering this and being mindful of the potential disruption and potential effect on staff retention as well. So one of the things that we found that's been particularly important is to be as transparent as possible throughout the process and also to provide kind of timely information and reassurance to staff. So when we made the decision to go down the employee ownership route, we had a really carefully considered communications plan, and we spoke with all employees months before the transition took place, and particularly before the wider market became aware of what we were doing. And that was just to inform them of the change well in advance and be really transparent about that. So, as part of the plan, we held a number of firm-wide briefings, and a lot of people kind of refer to these as sort of town hall meetings. But we also had some smaller group forums as well. And that was really to give employees the opportunity to ask lots of questions and to also help educate everyone on what the process actually involved and also the long-term benefits. And I think not only for the business as a whole, but also for them as individuals. And it was really helpful to use that as an opportunity to address any misconceptions at an early stage, and then also allow plenty of time for questions and discussion as well. And I think in terms of practicalities, the transactional side of employee ownership can be quite complex. But as with all employee communications, the fundamental requirements are straightforwardness, timeliness, and also honesty. And that can mean producing kind of communications in different styles and different forms. And that can really help build an understanding and also a trust around the process. And James has sort of mentioned this earlier, but EOTs are only possible in an incorporated business. And for some businesses, there will be a requirement to incorporate in advance. And it's helpful to be aware that incorporation does result in a change of employer, and that may trigger information and consultation obligations under TUPE. So that may also need to be factored into sort of timescales around that. And it's also worth having a think about whether there are any additional requirements, so things like new contracts of employment, for example, or any adjustments to remuneration or benefit structures. So it's quite helpful to kind of involve either your HR teams quite early on, or even get some professional advice at an early stage as well. And I'd say kind of careful consideration does also need to be given to that post-transaction phase. And I know this is something also James has touched on, but implementing the EOT structure isn't just a tick box, it's not kind of a one-off event. It is a change of approach for the future, which does require thoughtful planning, particularly around kind of ongoing employee involvement and engagement. And Simon's kind of mentioned there around kind of the involvement of trustees. And I would encourage employers to create the time and space for employees to get to know the trustees. And we found that a really helpful element as part of our own kind of process as well.
Yeah, and you've also already mentioned some of the advantages of the EOT structure. Can you expand a little bit more on how it specifically benefits both the company and its employees, I suppose, particularly around sort of culture and values?
Yeah, absolutely. We've talked a bit already kind of around the importance of getting the culture right, but some really attractive points around the EOT model is the ability for long-term stability, continued independence, and also that preservation of the company culture. So that is why many founders choose to go down the EOT route. It can help to preserve their company's unique culture. And it does allow kind of companies to keep their values intact, whilst also sort of providing the opportunity for these to evolve in the future as well. So having direct input of employees around that. So becoming employee owned can be a fantastic opportunity to further enhance your culture. And as I say, that additional involvement from employees can increase motivation and also retention. And Simon mentioned this earlier, but EOTs do tend to foster kind of a strong sort of message around a collective benefit, where reward from the success of the company can be more widely shared across the business. And James has touched on that kind of tax-free bonus element as well, which does in itself kind of the qualifying criteria around that does have inbuilt inclusion. And that can be a really strong message around kind of genuine accountability and shared purpose of everybody in the business. EOTs also require open communication and governance around kind of financial performance and also strategic direction. And that can create a really transparent workplace where employees aren't just informed, but they're also educated and empowered. And that transparency can really build trust in the organisation, which in turn can then sort of strengthen the culture. And employers do need to be giving thought to the structure and the mechanisms for employee engagement and involvement. And they may wish to think about things such as kind of employee voice groups or employee forums, and have really clear terms of reference around those as well. And employers also need to make sure that any such groups have representation from the whole of the population of employees. But having an effective forum or a committee and facilitating that sort of genuine and constructive relationship between the staff, the EOTs, and the board, and also the leadership team, can ensure that employees have a genuine and considered collective voice, and that can add real value to the business in kind of the longer to medium term. And Simon's mentioned that statistics do show that employee-owned businesses have improved rates of productivity and growth. And we ourselves, kind of post-transition, have found really positive initiatives and different ideas arising from our own employee engagement committee. And that's something that we did form as part of kind of becoming employee-owned. So employers who do plan these kinds of initiatives well in advance of conversion will have a positive opportunity to engage with employees and just communicate that not only will culture and values be protected, but there is a lot of ongoing opportunity to really influence and improve workplace culture for the future as well.
It's definitely, an area that people don't think about as much. And, it is something that we have been massively highlighting to people about, not just the legal and the tax side, but is getting that people and culture element right. And, it makes a massive difference to what we do. But Simon, I'm just going to come back to some of the technical bits actually as well. Now, when a business is thinking about becoming employee owned, what sort of transaction elements do you think they need to think about in advance or possibly prepare for prior to becoming EOT?
Yeah, so whilst creating an employee ownership business has many advantages, there are some pitfalls, and it's important to take professional advice in planning and structuring the transaction, not just from a legal perspective, but also from a tax perspective as well. As part of the sale process, you'll need to consider various factors which will need to be agreed between all the selling partners and the new trustees. And this is where some potential EOTs fall down, because the selling partners just can't agree between themselves to what they want to do. And the EOTs work particularly well where companies have a small number of shareholders, all of whom are at a similar stage within their personal succession planning, with none of them looking to retire for a number of years. You also need to consider various transactional elements, such as the share purchase agreement, the valuation, how the conversion is going to be funded. Usually this is funded from the future profits of the trading business. And then in that element, you'll have to consider how the deferred consideration position may look like and how that will affect day-to-day cash flow and operations. You also have to liaise with your ongoing management team on whether you're going to make any changes to that structure. It also may be necessary to deal with potentially regulators. You may need to get some consents if required, for instance. You'll have to factor this into your timeframes, really accounting for any possible delays coming from those regulators. You should also consider contractual arrangements with clients, customers, and suppliers, as the sale to an EOT is technically a change of control, particularly if you're going to sell 100% of the business. And therefore, contractual arrangements should be reviewed and considered as part of this exercise, just to ensure there's no automatic termination of contracts upon that change of control taking effect, and if necessary, negotiate possibly new terms.
Yeah, it was certainly something we saw as well, going from obviously LLP to limited company prior to do that. Is that sort of involvement for us from the Solicitors Regulation Authority at the time and what we had to do with our clients. So it was definitely something we had to massively factor in, getting consent from clients and things. So definitely something for people to think about, as they convert, really. But yeah, thanks so much for that, Simon. So this has really just been sort of a nice whistle-stop tour of EOTs and covering off some of those elements, whether they be legal, tax, and people and culture, which pretty much brings us sort of to the end of this webinar, really. So I would obviously like to thank all of our sort of panelists. Thank you for joining us today on there. And thank you to all of you as well for listening in and joining us on this sort of introduction to becoming employee-owned business. I really do hope that it has been helpful for you. And if you do have any more questions, though, now, you are welcome to put them into the Zoom chat, and we'll certainly answer them and follow up with you all via email. On the screen, you'll also find the contact details for all of our speakers today. If you would like to contact them directly, they are more than happy to have an open chat with you about EOTs, our experience, and the benefits as well. We're also going to circulate this recording and do a follow-up email as well. So again, if you've got any extra questions that you haven't raised in the chat, they'll be there as well as everybody else's answers in due course. You can also find a lot more information about EOTs and succession planning in general, both on the Myerson and the Armstrong Watson websites. So once again, from me, thank you very much for joining us. This has been the Myerson Introduction to Employee Ownership.